Hi there, I'm Jason Ayers, founder and president of OptionSource.net, and thank you for joining us to learn about gaining market exposure using SXM futures. With SXM futures valued based on the S&P/TSX 60 index, an investor may wish to take advantage of a directional bias on the Canadian market. If the outlook is bullish with the belief that the S&P/TSX 60 index is going to go up in value, SXM futures contracts may be purchased. If the outlook is bearish with the belief that the S&P/TSX 60 index is going to go down in value, SXM futures may be sold, or in other words, shorted. Let's assume that an investor believes that the index is going to appreciate. With the S&P/TSX 60 futures valued at 800, the investor may choose to go long one SXM contract. As an alternative, 2,000 units of an index tracking exchange-traded fund could be purchased at $20 per unit. With the index trading at 800, the SXM contract would be valued at 40,000 Canadian dollars. We arrive at this figure by multiplying the index value by the 50 Canadian dollar point value. A similar position can be created by purchasing 2,000 units of an index tracking exchange-traded fund valued at $20 per unit. An important consideration is that the investor is required to put up only $1,500 per contract to assume the long SXM position based on the minimum margin requirements. While this amount is subject to revision dependent upon market conditions, the purchase of the 2,000 exchange-traded fund units will require a minimum of $12,000 based on a typical 30% margin requirement. Assuming that the S&P/TSX 60 increases 40 points, the index tracking exchange-traded fund would increase $1. In both scenarios, the investor has achieved a 2,000 Canadian dollar profit. When considering the profit as a percentage of the margin requirement, the SXM futures contract purchase reflects a 133% gain, while the purchase of the 2,000 units of an index tracking exchange-traded fund reflects a 17% gain. It is important to consider that the investor utilizing the futures contract has achieved the same profits as the holder of 2,000 units of an index tracking exchange-traded fund. However, this is accomplished by using significantly less capital, resulting in a much larger percentage rate of return. By not having to put up as much margin requirement, the SXM futures trader is free to allocate the remaining capital elsewhere. Let's now assume that an investor believes that the index is going to depreciate in value. With the S&P/TSX 60 index futures valued at 800, the investor may choose to sell, or in other words short, an SXM contract. Note that the margin requirements for both a long and short SXM position are the same. This table reflects the potential profit generated as the index decreases. Notice that as the index rises, the position reflects a $5 per tick or $50 per point loss. Remember that each tick is worth 0.10 of a full point. SXM futures offer investors many advantages. This includes efficiency in terms of being able to participate in a broader market outlook without having to buy or sell numerous equity securities, as well as the flexibility of being able to participate in either an increasing or decreasing market. With SXM futures requiring an initial margin deposit representing a small percentage of the contract value, investors can take advantage of a greater leverage with the possibility of an increased percentage rate of return. This also frees up more capital compared to buying or shorting stocks or exchange-traded funds. Finally, investors can also take advantage of reduced transaction costs when compared to the traditional purchase and sale of equity shares or exchange-traded funds.